All right, Marcus here, and I need you to lock in for the next few minutes because silver just printed around $94 an ounce on the day's high after opening near 88. That is not a normal tape, it's a regime signal. And it matters for you even if you've never owned an ounce of silver in your life, because it's telling you something about liquidity, collateral, and trust in paper claims versus real supply. It's not about a hot commodity. It's not about a meme trade. It's not about a chart pattern. It's about what happens when financial conditions tighten in one place and the system tries to relieve pressure somewhere else. And the open loop is simple. If this move is being driven by a physical constraint rather than a speculative bid, what breaks next? Here are the portfolio stakes in plain numbers. If silver moves from 88 to 94, that's roughly a 6 to 7% move in a single session. For a conservative investor, that's the kind of daily move you associate with high beta equities during stress, not a monetary metal. Now imagine the same volatility shock hitting the rest of your balance sheet. Your credit spreads, your refinancing risk, your duration exposure, and your liquidity buffer. One big move doesn't ruin you. A correlated sequence does. Verdict: the signal isn't the price, the signal is the speed. So here's the promise. By the end of this video, you will understand three things: what this silver spike actually means for your money, why the mainstream framing misses the mechanism, and how to position structurally without gambling. Most people miss this next part because the real story is not silver up. The real story is which claims are still trusted when stress rises. And before we go further, I'm going to plant 4 questions in your mind. Do not try to answer them yet. Just hold them. First, is silver at these levels a symptom of inflation returning or a symptom of liquidity leaving? Two very different worlds. Second, if the system is well supplied, why are deliverable inventories and coverage metrics flashing stress signals? Third, if the economy slows and risk assets wobble, does silver get sold for liquidity or does it become the liquidity? Fourth, and the big one, if more holders demand conversion from paper exposure into specific metal, does the system absorb it smoothly? Or does it ration it through spreads and premiums? We're not answering those yet. We're going to earn the answers, and we'll come back to every single one in the final stretch. Now let's reveal the mechanism in simple language. The modern bullion market runs on a 2-layer system. Layer 1 is paper exposure. Futures, forwards, unallocated accounts, ETFs, synthetic hedges. It is deep, fast, and liquid. It's built for price discovery and risk transfer. Layer 2 is physical settlement, specific bars in approved locations, under specific rules, with specific paperwork. It is slow, precise, and constrained. In stable conditions, those layers stay aligned because confidence is high. If you want price exposure, you buy paper. If you want metal, you can usually source it with a modest premium and a reasonable delivery window. The arbitrage keeps the system tight. But when confidence shifts, the linkage weakens. The paper layer can expand instantly, the physical layer can't. So the system clears the difference through price, spreads, and rules, especially around what counts as deliverable right now. Here's a clean example. A standard COMEX silver futures contract represents 5,000 ounces. At roughly $90, that's about $450,000 of notional exposure per contract. If you have 100 contracts, you have exposure to 500,000 ounces, about $45 million notional. Most of the time, nobody expects you to show up and demand 500,000 ounces. They expect you to roll, offset, or cash settle economically through the market. But the moment more participants start acting like they want the second layer, real bars, real warrants, real delivery windows, the system's true constraint shows up: deliverable inventory. And right now, that deliverable layer is the tension point. One widely followed aggregation of COMEX warehouse data shows registered deliverable silver around 86.1 million ounces, and eligible silver around 274.5 million ounces. Registered is down about 24% in the last 30 days, roughly 27.1 million ounces, while total inventory is down about 55.8 million ounces over the same window. That is a drain, not a reshuffle. And with open interest translated into ounces, you're looking at paper claims many multiples larger than deliverable supply, about 7.6x by that same aggregation. That's not apocalypse, but it is stress. This isn't a flaw, this is the design. The design is that most contracts are not meant to end in trucks and pallets. They are meant to net out financially. Physical delivery is the pressure valve, not the default. So when you hear dramatic lines like vault scrambled or the system is being drained, don't get hypnotized by the theater. Translate it into the only questions that matter. How much is deliverable? How fast is it changing? And what happens to spreads when the market wants the second layer, more than usual? Now we build the macro chain, cause to effect, so you can see why this is happening now. Start with the policy anchor. The Federal Reserve's target range is sitting at 3.50% to 3.75%, with the upper limit at 3.75%. That alone changes everything because it sets the risk-free hurdle rate for the entire financial system. Mortgages, corporate credit, commercial real estate, bank funding, and the discount rate investors apply to future cash flows. Next, layer in the balance sheet anchor. Total Federal Reserve assets are about $6,714 trillion as of the week of February 25, 2026, down from the peak years, but still enormous in absolute terms. That number matters because it's a proxy for how much structural liquidity has been injected into markets over the last cycle and how difficult it is to remove it without something cracking. Now add the market stress anchor. High-yield credit spreads, measured by the ICE BOFE US High-Yield OAS, were about 2.98% on February 26, 2026, up from 2.86% just a few sessions earlier. That is not a crisis level, but it is a directional message. The market is demanding a higher premium to absorb lower quality credit risk. And one more anchor. The 10-year Treasury yield closed around 3.942% on February 27, 2026 in the available historical dataset, meaning long rates have been moving even as inflation headlines stay noisy. When yields fall while spreads widen, that's not a good growth story. That's a selective safety story, not panic, not rumor, not Twitter. This is how the system behaves when investors start valuing liquidity and certainty more than marginal return. Now here's where silver enters the frame in a way most investors miss. Silver is not just a precious metal, it is a hybrid collateral asset. In risk-on phases, silver trades like an industrial input with leverage, volatile, cyclical, sensitive to global manufacturing and sentiment. In risk-off phases, silver can trade like a monetary substitute, especially when trust in paper claims is questioned and when the public wants something outside the banking system. That's the trap. Because if you assume silver is only industrial, you get blindsided when it behaves like collateral. And if you assume silver is only monetary, you get blindsided when it sells off to meet margin calls. That's the risk. So what changes the behavior? The answer is almost always the same: liquidity conditions and collateral preference. When liquidity is abundant, investors prefer convenience. They own paper exposure, they chase yield, and they accept counterparty chains. When liquidity tightens, investors prefer control. They shorten duration, they reduce credit risk, and they start asking inconvenient questions about delivery, settlement, and custody. That's the signal. Now let's connect that to the vault narrative without exaggeration. Even if you never look at a warehouse report in your life, you can understand the incentive structure. If deliverable supply is shrinking and price is rising, then anyone who needs physical silver for industrial reasons or for inventory certainty has to compete with financial demand. The competition doesn't necessarily show up as empty vaults. It shows up as a rising premium for immediacy. It shows up as tighter spreads. It shows up as higher implied volatility, and implied volatility is screaming. CME's Silver C-Vol, an implied volatility measure derived from options, was near 89.99 on February 27, 2026. That is the market telling you, in plain numbers, that uncertainty about future prices is elevated, not because everybody suddenly learned to love silver, but because the distribution of outcomes has widened. That's the trap most people fall into. They see the price and they argue about fair value. Meanwhile, the market is shouting about convexity and tail risk. Now let's step back and do pattern recognition, because this has happened before, just not always in silver. In every tightening cycle, there is a moment when the system discovers which assets are truly liquid and which assets only looked liquid because leverage made them so. In 2008, it was structured credit. In 2020, it was treasury market functioning and dollar funding stress. Different instruments, same lesson. When everyone wants the same kind of liquidity at the same time, the market clears through forced repricing. Silver has its own version of that story because of the two-layer structure. Paper exposure is easy, physical conversion is constrained. So the parallel isn't silver is 2008. The parallel is this. When the marginal buyer starts caring about settlement quality, the market begins charging you for it. And that's why you get moves that feel discontinuous. The lesson wasn't learned, it was postponed. Now we shift agency. Because at this point you might be thinking, okay, Marcus, interesting, but what do I do with this as a long-term investor who cares about capital preservation? So here's how you position 3 asymmetric plays. First principle, build a liquidity barbell that you control. That means more true cash and short duration, high-quality instruments on one side, liquidity that doesn't depend on selling something into a stressed market, and carefully sized exposure to real assets on the other side. Not because you're trying to beat the market, because you're trying to survive the market when correlations rise. Second principle, reduce counterparty distance. The more steps between you and the asset, the more ways you can be right on price and still wrong on outcome. ETFs, derivatives, unallocated claims, rehypothecation chains, these can be efficient in calm periods. In stress periods, the question becomes, what exactly do you own, and what are you entitled to, and under what conditions? Your goal is not paranoia. Your goal is clarity. Third principle, avoid time lock risk in the wrong places. If rates stay higher for longer, duration becomes a slow bleed. If growth weakens, credit becomes a sudden bleed. The asymmetric move is to keep flexibility, so you are not forced to refinance, forced to sell, or forced to accept poor terms. Optionality is an asset. Treat it like one. No hype, no hero trades, just structure. Now let's talk timing, because the market is giving acceleration signals. 1. Silver's own daily range is extreme, roughly 87.96 to 94.09 in the cited daily snapshot. That's not healthy, stable price discovery. That's a market recalibrating rapidly. 2. Deliverable COMEX registered silver has fallen sharply over a 30-day window in the aggregation we referenced, down about 27.1 million ounces, with total down about 55.8 million. When the deliverable layer shrinks that fast, it does not guarantee higher prices, but it does increase the odds of spread events and dislocations. 3. Credit spreads are widening at the margin, high-yield OAS around 2.98% on February 26. That's not a crash, but it's a cost of capital signal. Or policy remains restrictive relative to the last decade. The Fed funds target range is still 3.50%, 3.75%. That keeps the pressure on leveraged balance sheets and on duration illusions. 5. London Vault holdings show silver stocks at roughly 27,129 tons. At end January 2026, down 0.3% month over month, with the LBMA valuing that silver around 92 billion at month end. London is a major part of the physical plumbing. When you see even small percentage changes at that scale, you pay attention. These aren't healthy system signals. Now we go back. Remember those 4 unanswered questions. This is where it connects. Here's the piece most investors overlook. The answers are not bullish or bearish, they are conditional, and once you understand the conditions, you stop reacting emotionally to the price print. Now remember the first question I asked earlier, is this inflation returning or liquidity leaving? Answer: the move can reflect both, but the current configuration looks more like a liquidity and trust event than a pure inflation story. Why? Because we're simultaneously seeing restrictive policy rates, 3.50%, 3.75%, a large but still constrained liquidity backdrop, and early signs of risk repricing in credit spreads. In that environment, assets that sit at the intersection of collateral preference and outside the system psychology can spike, even without a fresh inflation impulse. Silver's volatility profile, reflected in the elevated CVOL reading, supports that interpretation. The market is pricing uncertainty and tail outcomes, not steady inflation drift. Second question, if the system is well supplied, why are deliverable inventories and coverage metrics flashing stress? Answer: because total supply and deliverable supply right now are not the same thing. Eligible metal exists, but it is not automatically committed to delivery. It can be reclassified, but that depends on incentives, owners, and timing. The stress shows up when registered, falls quickly relative to open interest-derived claims. A coverage ratio around the low teens, like the 13.1% figure in the referenced aggregation, isn't proof of failure. It's proof the system is leaning harder on confidence that most paper claims will net out financially. Third question, if the economy slows and risk assets wobble, does silver get sold for liquidity or does it become the liquidity? Answer: both can happen in sequence. In the first wave of stress, silver can be sold because it is liquid and because margin calls don't care about your thesis. That's why silver can drop alongside equities in sudden shocks. But if the stress evolves from sell what you can into own what you can control, then silver's monetary character can reassert, especially if confidence in counterparties weakens. The practical takeaway is not to predict the next tick. It's to size exposure so that a forced sale phase does not damage your long-term plan, while still allowing participation if the system shifts toward collateral preference. Fourth question, and the big one, if more holders demand conversion from paper exposure into specific metal, does the system absorb it smoothly or does it ration it? Answer: the system's first response is usually price and spread, not default. It rations through higher premiums for immediacy, through changes in lease rates and forward curves, through reclassification from eligible to registered, and through the simple fact that physical logistics have time constraints. That's why the vault drama is often misunderstood. The market doesn't need to run out of silver to create pain. It just needs deliverable supply to be scarce at the margin when demand shows up quickly. The observed drawdown pace in registered inventory alongside elevated implied volatility is exactly the kind of setup where those rationing mechanisms become more visible. Now, with those answers in place, you can see the strategic point. The silver spike is not an invitation to chase, it's a diagnostic. It tells you the system is pricing a wider range of outcomes at the same time that deliverable supply metrics are tightening. And in a world where policy remains restrictive and credit is repricing at the margin, that combination is exactly when disciplined investors focus on resilience, not bravado. So here's your weekly action checklist. Exactly 4 moves, structural, not tactical. Reduce concentration risk. If your outcomes depend on one equity index, one sector, one employer stock, or one real estate market, you don't have diversification, you have a disguised bet. Fixed duration. Audit every place you are locked into long maturities or refinancing risk, long duration bonds, private credit, illiquid funds, adjustable rate liabilities. Bring optionality back into the plan. Timeline. Know what you own and how you own it. Brokerage terms, fund structures, counterparty exposure, and where your safe assets actually sit in the chain of claims. Risk. Improve custody, control. That means a real mix of cash-like instruments, high-quality duration you can tolerate, and a measured sleeve of real assets or inflation-resilient exposures, sized so you can hold through volatility. Strengthen structural diversification. This is not a trade. This is insurance. One last line because it matters. This is education, not financial advice. Now I want you to choose, in the comments, which risk you think is bigger from here. A liquidity-driven downdraft that forces selling across assets. Or B, a settlement and premium problem where paper exposure diverges from physical reality. If you found this useful, follow and subscribe, because this cycle is going to reward structure and punish complacency. And share this with the one person you know who still thinks liquidity is just a buzzword. The only question is whether you act while exits are open. Stay sharp, stay informed, stay ahead.